But first, Niti now. But let's take it across to Mayuresh Joshi from Angel Broking and chat about the fundamentals that the market is dealing with. Mayuresh, morning. Can't take your eyes away from ICICI Bank. Do you also believe that the worst is behind and it makes for a buy right now?
Morning, Ayesha. Oh yes, I think I am optimistic on ICICI Bank and I was over the past few weeks and months. The premise that Nikunj was putting forth in terms of retail gaining a huge amount of traction, I think that's very, very evident both in terms of the 21% retail advances growth that we've seen. And again, the 60% target that the bank is probably looking at is quite plausible and possible over the next few quarters. Having said that, I think the fourfold increase in slippages of 15,000 crores also included the RBI dispensation. So in that sense, again, I think whatever was required as per the RBI circular and the drill down of watch list to 4,000 odd crores has been done. Does that mean that quarter one, quarter two will start showing fabulous numbers? Again, I think the provisioning figures, at least for Q1, Q2, might still be on the higher side. But the second half is where our belief is the recovery can probably come through. And then it's not going to be about asset quality because the last few quarters were all about asset quality for ICICI Bank. It's all going to be the earnings momentum that the bank can drive. And the other interesting aspect is also going to be the NIMs. So the NIMs have shown expansion. The non-interest income portion, the retail fees from 75%. So I think that's a significant traction going ahead as well. And as Siddharth was mentioning, I think the ratings in the corporate structure that ICICI Bank lends to, I think they're giving their credits to largely better rated corporates. So I think even the corporate book should grow at a decent clip. Valuation-wise, yes, one of the cheapest stocks. So remain very, very optimistic. It's one of our top draws in the Indian banking space.
Well, it's ICICI Bank, but the other one which I want to discuss, Mayuresh, with you is Jubilant FoodWorks. Great numbers, bonus. I mean, it clearly means that Indians are buying pizzas and they're eating pizzas for breakfast also, because 26% uptick in same store sales is phenomenal. Yet the market reaction was very muted.
Morning, Nikunj. I think to a large extent, the numbers that were expected from Jubilant FoodWorks was expected to be a blockbuster. So they did deliver on that front. So the 26.5% SSG growth that you're talking about, again, I think phenomenal set of numbers. The second element is also the reduction of losses in Dunkin' Donuts, and the management is very, very optimistic by Q4 FY19. They should probably start breaking even on that sub-segment of their business, even in terms of store expansion and the kind of rationalization of costs that you've probably seen, both in terms of rentals of new stores and even the online delivery. So I think 65% of their online delivery is happening through mobile. So that's an encouraging sign in probably keeping a tab on your overall overheads. But again, I think you come back to the classical point of valuations. Valuations have been on the higher side for Jubilant FoodWorks historically. But again, I think if one really assumes, and the assumptions are going to be what kind of SSG growth can they probably deliver in terms of new stores coming through and the payback period and the break-even points of these new stores. So even if one assumes 15 to 18% SSG growth on a blended basis over the next few quarters, you're still going to see the EPS estimates of 60 odd rupees for FY20 getting surpassed if they probably carry on with their trend. So to a certain bit, I think if one really assumes EPS to land around 64, 65 odd rupees, there is some normalization in terms of forward Ps, but it is still on the higher side. So again, I think it's a very difficult task in terms of whether buying the stock at this point of time. But our recommendation is any investors who's probably holding on to the stock should hold on. Fresh investors should probably wait for declines if it does come through, because valuations, in our opinion, are on the fairer side for this stock at this point of time.
Now. But Mayuresh, let's try and understand the implication of the crude spiral up all the way to 76 now that US has ditched the Iran deal. IOC for now is holding back hiking prices, but do you think soon we would see a reaction come by on OMCs? And as an investor, how do you approach OMCs now?
So Ayesha, again, I think it's a classical story. I think crude prices are trending higher with what US has done in terms of the sanctions on Iran. So to a certain bit, the hike that the spike that you're probably seeing in Brent prices obviously act negatively for OMCs. A large element in terms of their sensitivity to earnings obviously hinges on two factors: the movement of crude, which is obviously detrimental with the move that we've probably seen, and again the depreciation of the rupee against the dollar. So I think both these factors probably eat into the earnings estimates for a whole host of OMC companies. The second element in terms of withholding price hikes, I think it's for obvious reasons why the price hikes are not happening at this point of time. And a large element of this will also play out in terms of how the return ratios pan out. So if crude sustainably stays above these levels for a higher period of time, I think the earnings profile for a lot of OMCs actually start getting hit. So the kind of correction that we've probably seen in OMC stocks with crude moving steadily over the past few weeks and months was reflected in the price correction that we've probably seen in these stocks. But they will now ideally like to see how crude prices behave. So I think it's going to be more of a time correction for these stocks with a knee-jerk reaction, obviously, if crude spikes even higher. But then a large element in terms of how their capex plans will go with higher crude and what probably happens in terms of their free cash flow yields getting hit if crude probably stays at those higher levels. Obviously, the earnings estimates are going to get cut on forward basis. So I think it's a time correction that these stocks will probably enter into, and then probably I think the monitoring will happen in terms of crude movement and the currency movement as well. So again, IOC probably is better placed within the three OMCs in my opinion. But again, one needs to wait for declines. Let this stock settle down, let crude settle down. There will be better entry points to get into IOC.
Mayuresh, we've talked about Britannia with you extensively. At 5,000 rupee plus, are you still holding on to your call on Britannia?
I am, Nikunj. And again, the premise here is very clear. I think there is a huge market for biscuits and the super premium category thereof. What a lot of players are probably trying to do at this point of time, including players like Parle, are getting into the super premium category because that is where the margins are probably higher, and that is where I think the incremental push through in terms of earnings improvement will come through. The second element in terms of Britannia's operating performance as well, the cost optimization at their end is very well expected to continue, and that itself will get the synergies that you probably require at the EBITDA level. The third element obviously is going to be earnings, and earnings in my opinion are extremely steady at this point of time. They're expected to remain steady going ahead as well, with reasonable amount of volume growth, and to a certain bit, even if one adjusts the input cost inflation, you probably are seeing the volume growth still sustain in conditions like these. So large element in terms of earnings sustaining itself, operating margins probably staying around the same levels and improving gradually as the premiumization unfolding still continues. The cost optimization also playing positively onto the operating dynamics of the company should play out positively.
Mayuresh, have you taken a look specifically at Indostar? The IPO opens today with an issue size of 1,800 odd crore rupees.
No, unfortunately, I did not get the time to go through the whole thing.
Let's discuss aviation then. And Mayuresh, that's the other sensitive pack, right, to crude price movement. Do you see merit in buying any of the aviation stocks after the recent fall post Interglobe's numbers? Or do you think this is a sector best avoided because of the direct correlation to crude prices and ATF prices thereby, and the kind of hit that they're going to take in their margins as well as profitability numbers, as was the case with Indigo in the quarter gone by?
So again, Aisha, I think you're right in terms of how crude prices are behaving at this point of time, and with ATF prices moving higher, 27 to 30% of their overall input costs is derived by crude. So I think a lot of elements in terms of analysis for aviation stocks and the working goes ex-crude. So when you're talking about the cost per available seat kilometer ex-fuel, I think that is where some of the dynamics at least are in control of the aviation companies. To a large bit, I think with the increase that you've probably seen in crude prices, again, it's the same old classical story like OMCs. I think the expenses are also accounted in dollar terms. So any depreciation in rupee along with increase in crude prices, I think that's a double whammy for aviation companies in terms of reported numbers. The third element in terms of load factors obviously are looking good. You're probably entering a very strong season, the holiday season, and that itself should ensure that occupancy of the load factors should probably stay at elevated levels. And that is getting clearly reflected by the available seat kilometers, which are increasing at a very fast clip. The revenue per available seat kilometer again is seeing signs of some stress because competitive and pricing pressures are probably eating into that element as well. So if I look at the holistic picture, the RASK, or the revenue per available seat kilometer, is probably looking constrained at this point of time. With the movement in crude and the other expenses that they need to account for, sale and leaseback, regulatory charges, airport charges, parking charges, depreciation, employee costs, I think that is probably going to eat into their EBITDA margins. And then again, I think the cost per available seat kilometer, including fuel, ex-fuel, I think the yields have significantly shown a decline. So again, I think typical with crude staying at elevated levels, I think the aviation stocks which have shown a knee-jerk reaction, I think they might also enter into a phase of time correction like the OMC pack. So again, one needs to wait for decline, but within this pack, I think SpiceJet is something that I'll continue to prefer. But like OMCs, I think one really needs to wait for declines on aviation stocks. Let that time correction play out. You'll get better entry points.
Okay, Mayuresh, on that note, let you go. Thanks so much for taking the time out and speaking with us today.